Hey there, have you ever wondered why big companies sometimes try to buy back their own publicly traded assets? Today, we're diving into a fascinating case that shows exactly how market conditions can force companies to change their strategies. If you've been watching the Singapore REIT market, you might have noticed something interesting happening with Fraser's Hospitality Trust. In a surprising move that's sending ripples through the Singapore property market, Fraser's Property has just announced a second attempt to take Fraser's Hospitality Trust private. But why now? And what does this tell us about the broader economic picture for REITs and hospitality assets? The answers might challenge what you think about investment timing and strategy. Want to dive even deeper and get exclusive investing insights delivered to you every single day? For just $1 a month, you can become a premium member and unlock a wealth of additional content, including daily REIT analysis, early insights into promising market trends, and deeper dives into specific investment strategies that will give you a real edge in growing your wealth. Think of it as your daily dose of financial fuel. More on how to join after the intro. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers with over 850,000 reads and 53,000 likes. I've produced over 800 videos with more than 350,000 watch hours as of February 2025. I also focus on regional and global economic trends. Let's break down what's happening with Fraser's Property and why it matters to investors like you. Fraser's Property has just announced a bid to privatize Fraser's Hospitality Trust at $71 per stapled security. This values the trust at about $1.37 billion total. If you're keeping score, this is actually their second attempt to take FHT private in just 3 years. The offer price represents an 11.1% premium over FHT's net asset value. To put this in perspective, the average premium for REIT privatizations in Singapore since 2020 has been around 4%. So Fraser's Property is offering a significantly better deal than the market average. Think of it like buying a house that's valued at $100,000, but you're willing to pay $111,000 for it. That's a pretty good deal for the seller, right? That's essentially what Fraser's Property is offering to FHT security holders. But wait, didn't they try this before? Yes, back in September 2022, Fraser's Property attempted to privatize FHT at $70 per security. That attempt failed by the narrowest of margins. They needed 75% approval but got 74.88%. Talk about a photo finish. So why try again now? And why should you care as an investor? The key reason cited by Fraser's Property is the worsening macroeconomic environment. What does this mean in plain English? Several things are happening that make it harder for FHT to grow. First, foreign exchange rates are working against them. The Singapore dollar has been strengthening against other currencies, which means overseas earnings are worth less when converted back to SGD. Imagine you're earning money in US dollars, but every year, each US dollar buys fewer Singapore dollars. That's the challenge FHT faces with its international properties. Second, interest rates have risen significantly. This increases borrowing costs, which directly impacts FHT's bottom line. Think of it like your home mortgage. If your interest rate jumps from 2% to 5%, suddenly a much bigger chunk of your monthly payment goes to interest rather than building equity. These factors have made it increasingly difficult for FHT to grow its distributions to security holders. In fact, FHT just reported a 6% drop in its distribution per stapled security for the first half of their fiscal year. But there's more to the story. Let's look at the structural challenges facing FHT. One of the biggest issues for FHT is its relatively small size in the REIT market. During the media briefing, Eric Gan, CEO of FHT's manager, highlighted that FHT struggles to attract capital flow due to its scale. Think of it like being a small fish in a big pond. Institutional investors, the ones with the really big money, tend to focus on larger REITs where they can deploy significant capital without moving the market price too much. As a smaller REIT, FHT simply doesn't have the visibility or liquidity that larger players enjoy. This creates a catch-22 situation. FHT needs to grow to attract more investors, but it struggles to grow because it can't attract enough investment capital. It also has less debt headroom compared to its peers, limiting its ability to make acquisitions that could help it grow. What's particularly interesting is how the COVID-19 pandemic has had lasting impacts on FHT's valuation. Before the pandemic, FHT was trading at 0.95 times its NAV, not too far from what investors would consider fair value. After the pandemic, this dropped to a 7.3 times NAV. This persistent discount suggests the market has fundamentally reassessed the value of hospitality assets. Does this sound familiar? Many REITs globally have faced similar challenges in the post-pandemic world, especially those with significant exposure to hospitality assets. So why is privatization the answer? The board of FHT considered several alternatives: keeping FHT listed but potentially selling some assets, or rebalancing the portfolio, selling the entire platform to a third party, or taking the trust private. They ultimately decided privatization offered the best value for security holders. Here's why. First, it gives security holders certainty. They get an immediate premium over the current trading price and NAV rather than waiting for potential future improvements that may never materialize in this challenging environment. Second, it's a clean solution. Rather than trying to restructure or rebalance in a difficult market, this provides a clear exit strategy. Third, it's backed by the sponsor, Fraser's Property, which has the financial resources to complete the deal. This reduces execution risk compared to finding a third-party buyer. When you think about it, this is similar to what happens when a company buys back its own stock because it believes the market is undervaluing it. Fraser's Property essentially sees more value in FHT's assets than the market currently recognizes. If you're a FHT security holder, this offer represents a solid premium over recent trading prices. The 0.71 offer is about 3.6% higher than the closing price of 0.685 on the day of the announcement. But the broader implications are more interesting. This privatization attempt signals that major players see disconnects between public market valuations and the intrinsic value of quality real estate assets. What should you look for in other REITs that might become privatization targets? Here are some patterns. REITs trading at significant discounts to NAV, smaller REITs that struggle with growth and liquidity, REITs with strong sponsors who have the financial capacity to take them private, and trusts facing structural challenges that are difficult to overcome in the public market. The privatization trend isn't limited to Singapore. Globally, we're seeing similar moves as sponsors and large investors recognize the value gap in public markets. If you're wondering what happens next, the scheme meeting for stapled security holders is expected to be held in late July 2025. If approved, the privatization would be completed by the end of August 2025. For the deal to go through, it needs approval from security holders representing at least 75% of the units. Given how close the last attempt came, missing by just 0.1%, this vote could be another nail-biter. What's different this time? The offer price is higher, and the macroeconomic environment has deteriorated further, potentially making security holders more receptive to an exit opportunity. So what have we learned today? Fraser's Property's renewed bid to take Fraser's Hospitality Trust private highlights several important investment lessons. First, macroeconomic factors like foreign exchange rates and interest rates can significantly impact the REIT's ability to grow distributions, regardless of the quality of its underlying assets. Second, size matters in the REIT world. Smaller REITs face structural challenges that can limit their growth potential and trading liquidity. Third, privatization can be a viable exit strategy when public markets persistently undervalue quality assets. The key takeaway for investors is to look beyond just the dividend yield when evaluating REITs. Consider structural factors like size, sponsor support, and growth potential in your investment decisions. So, if you found this video helpful and want to level up your investing game with daily premium insights for just $1 a month, click the link in the description below to become a member. You won't regret having that consistent stream of valuable information that can help you on your financial journey. If you enjoyed this analysis, please hit that like button and subscribe for more insights on REITs, property investments, and market trends. Drop a comment below with your thoughts on this privatization attempt. Do you think it will succeed this time? For more on Singapore REITs, check out my previous video, Top 5 Singapore REITs to Watch in 2025, where I break down other interesting opportunities in this sector. Thanks for watching, and I'll see you in the next video.